Hello everyone and welcome to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters across the franchised and independent dealer sectors.
Well, welcome back to the podcast, Robert. It's really good to have you back on.
No, it's great to be invited.
Yeah, we've got lots to talk about. So what we'll do is we'll start with your financials, because a fortnight ago, Vertu published its results for the full year ended 28th of February. So we actually thought this would be a good opportunity to catch up with you and hear your take on what shaped the year and your thoughts on current and future trading.
So, welcome, Robert. I think obviously we did talk about your results a couple of weeks back when they were first announced, but the results showed revenues were up whilst profits were down, which has been a kind of familiar theme when you're comparing 2024 to 23 there. And we obviously talked about that on the podcast, but what's your analysis on, what drove that? And as a bit of a follow-up, how much of an impact did some of the brands get switching to agency have on your profitability?
Well, dealing with agency first, I don't think it had any impact whatsoever, to be honest with you. You could argue in a push market that agency is beneficial. A genuine agency, you have no stocking charges, you have no discounting, so your new car profitability is robust as long as the manufacturer can deliver the volume. So I don't think agency was a major feature, and actually our presentation to investors didn't really discuss agency once.
Right.
So I don't think that's in any way where we were. I think last year, and remember our year ends to the end of February, so it's broadly 2024, a bit of 25. We knew we were going to have cost pressure. That was obvious. The budget last year, year before last, had increased the national minimum wage quite substantially. There were going to be major knock-on effects of differentials because this minimum wage had been creeping up quite a lot. I don't think we'd moved the differential, so we had a big cost, about £10 million a year increase in core cost base. Bulk of that was payroll, but there were also big increases in demonstrator costs, more EVs depreciating at a rapid rate, impacting demo costs. And we did take some cost actions to try and reduce marketing, which we did quite considerably, but still there was a £10 million increase in cost, which I think we broadly knew about. We knew aftersales was going to be good, and it was. It was up 12 million quid in gross profit in the core. We knew used cars would recover from the very poor year the year before when residuals collapsed. Fleet is a big generator for us. Okay, let's assume that's level. The real issue was new retail. And new retail, we thought we'd see some growth. You normally get a little bit of growth, don't you? But actually, we saw an £11 million reduction in gross profit in the new car channel. So the entire decline in profits, which was about from 34 to 29, I think it was, came from the new car channel. And all the issues around that were as a result of the government's, plural, and the ZEV mandate. Yeah. Because the market was in a very poor state. The manufacturers were discounting 4.5 billion quid to get electric vehicles in. The private market ended up with a 10.7% mix of battery electric vehicles in that period. The targets were 22%, were way ahead of where most manufacturers were actually tracking, despite the discounting. And then we ended up literally rationing petrol and diesel cars. So you put all that together, we had lower volume, lower margin, and much reduced profit in new cars, which I didn't fully anticipate when we started off the year. So that is really where that year was. Let's be honest, it was the lowest retail market in new cars for 25 years. We should be sending the government a gold medal because who thought they could have actually done that? We sold less cars than during COVID.
It's an achievement.
It's a major achievement, but actually you half wonder whether they want it. Actually, they don't. I don't think the civil service, and I think the misnamed Department of Transport, I'm not sure even like cars. In fact, I'm pretty sure they don't.
Do you get the feeling, just slightly honest, you saw that all last year, you get the feeling it's the same again this year, or do you think that pressure from the OEMs has eased this year a little bit?
Very good question. And the truth is, I don't know. They obviously moderated the ZEV mandate in April. Knee-jerk reaction, in my opinion, to the Trump tariffs. It was done over that weekend, wasn't it?
Yeah.
In fact, I got given a press release at 3:00 on the Sunday afternoon that bore very little relationship to the actual announcement at 10:30. And I get mixed signals from manufacturers. I think on balance, the increased flexibilities, and I have to say I'm not an expert on that because understanding all that I think is very difficult, must make life for manufacturers and therefore retailers easier.
Yeah.
But I don't think it's game changing.
Yeah, it feels there might be a little bit, because obviously the OEMs seem to be releasing a little bit more ICE product into the market.
Yeah,
probably as an opportunity to try and recover some of the revenues, the loss of profits.
and that's where they make their money. So why shouldn't they? So I think, I mean, let's be brutally honest. If you think we're going to get to 28% BEV mix this year, you are utterly delusional and know nothing about the car market.
I don't think anybody's forecast it, have they? I think even the SMMT are 23.5%, I think, at the minute.
That is the government target still. Yeah. And next year's 33. So how are they going to explain all this to the public? I don't know. I don't know is the answer. I think we have to wait and see. And it'll all come in the second half like it did last year. But we literally last year, in the last quarter, had manufacturers who had no money, no appetite, and no plan. And the retail network clearly suffered because there was no volume. They'd already spent the budgets. They'd tried to push electric. They just gave up and reconvened in 2025, which is clearly not good news for retailers. Will we see that again? Well, let's be slightly optimistic and say that the moderation will take the worst effects of it off.
And Robert, just going back to your results, despite the challenges that you've outlined, you did actually see growth in retail EV sales, which were ahead of the market. And you also, as you've already alluded to, you saw a strong performance in used car sales and after sales. Can you take us through the progress that you made across those three areas and what actually drove that?
Yeah, if we take retail BEV first, we put a lot of effort into retail BEV from about this time last year. A lot of training, a lot of conferences, a lot of focus, mystery shops. The market to the end of February, 12 months to February, private EV sales grew 12.9%, and Vertu, like for like, grew BEV sales 83%. So a massive outperformance in BEV, which let's hope will continue. And Hereford Volkswagen, number one in the network, in Volkswagen network, Mini York, number one. So we had a good time. Didn't save us from a profits warning, but still could have been worse.
Yeah.
In terms of used cars, it was always going to go up, wasn't it? Because we were not going to have a collapse in values and profitability that we saw in quarter four 2023. I think there are some positives and negatives about used cars at the moment. I'm exceedingly negative, and in fact, Mr. Nottard was in the Telegraph this morning on the subject about battery electric vehicle residuals.
Yes.
Which for a variety of reasons are going to be problematic, because the pace of technological change in battery electric vehicles is staggering. A car today is not what it was 3 years ago. Range, tech, design. So trying to get those 3-year cars into the used car market against discounted, low-rate finance battery electric vehicles, I think it's going to be a devil's own job. And the people who've got them sat on their balance sheets, manufacturer finance companies, contract hire and leasing companies, subscription businesses, if there are any left, and Motability, are clearly going to have some major challenges.
I think that's the thing now, isn't it? It's the particularly if you look at that 0 to 24-month-old market, where you've got, as you say, those asset holders, be it demonstrators, courtesy cars, lease fleet, rental, etc. They are fighting now against those still very aggressive new car.
They are, and let's be honest with you, and this I think could have an interesting impact on the used car market. We're now seeing 21 grand, 20 grand, 22 grand good electric vehicles coming into the new car market. So I think that is a very interesting and positive thing for battery electric vehicles, but could impact used vehicles. There's clearly a structural shortage of used cars in the 3 to 5 year bracket. That is bread and butter for franchise retailers. It's quite clear franchise retailers are losing market share compared to independents, because independents tend to be 5 years older cars. And I think that's putting pressure on used car volumes. I think used car volumes are under pressure for a number of reasons. I think manufacturers this year are putting more effort into retail new car sales, better deals, better finance. And I think that's impacting used, and we're just not getting the supply through. But so I think people are more going for margin rather than volume.
It is fundamentally wrong when you look at a mocker equivalent. So you look at the EV versus its petrol equivalent, that it's over £5,000 cheaper in trade value than its petrol equivalent. Highlights the fundamental issue in the used market for EVs, doesn't it? Essentially.
Yeah, but if a retailer buys them right, then it will sell them right, won't it? Yeah. So I think there's an opportunity in used EVs. Clearly there is. You just don't want to be, and demonstrate as being the issue, of course, you don't want to be holding them for too long.
You don't want to be hanging on to them, because the market shifts very quickly at the minute. That's the bit.
In an absolute disaster. But the general used car market, I think values will be strongish, actually. It's just getting the stock and actually driving the volume.
And I mean, back to sort of your financials and thinking ahead, and obviously, you mentioned in the 2024 results the impacts, and we spoke about it a couple of times, of that rising cost pressures from minimum wage, which is continued to, it's one of those impacts on a business that it's just a cost. It's just a pure cost coming into your operation that you have no control over. But in terms of, recalibration of your business to, offset these cost pressures, and, we've got to talk about the autumn budget, especially on the, the national insurance employer contributions that obviously came into effect in April. How much additional cost did that the budget add to your business, and how are you mitigating it?
It added £10 million to our underlying costs, and we looked at all costs between October and February, and we made savings in excess of that, because we were not going to absorb that £10 million. Okay. We'd absorbed £10 million a year before. We were not going to do it again. So we had a root and branch from senior to dealership level review of headcount, probably for the first time in a lot of years. Reduced the headcount by about 3.8%, which is not a massive number, just under 300 people. Some of that actually related to dealership closures. So we closed Dorchester to BMW, which was an authorised repair and used cars outlet, and the same in Barnstable. So that contributed to the 200 odd. Not something I ever relished doing necessarily, but just had no choice. And I think every British business has done exactly the same, because it can't afford to carry on that way, which is why unemployment's gone up, of course. So we made cost savings offsetting that. The pressures on British business are going to continue forevermore. So we have a very defined digitalisation AI strategy with regards to pushing more and more efficiency into the business, making everybody a lot more efficient. So that we can increase productivity and potentially reduce costs, and I think we're well on our way with that.
And just as a follow-up to that, Robert, the sort of savings that you made over the course of the year, are some of those savings, are you able to carry those sort of processes into this year to also make savings?
Oh no, sorry, So there's a one-off headcount reduction, but that's not a knee-jerk reaction. That's a structural change. I mean, you know very well that we closed our sales outlets on a Sunday. Yeah. That allowed us to look at resource levels. But then we got a lot of work in the finance back office, making the finance function more efficient. Yeah. We've obviously gone to one brand now. Everything's branded Vertu. That simplifies the world of marketing and IT. One website, one set of development. The marketing money becomes more efficiently used, over 200 dealerships. So there's lots more to come.
Yeah.
We did do one thing actually using AI, which I thought was clever, which is, well, we got an algorithm which values used cars, and we change prices on 70% of our stock every day, up and down on used cars. But we were still discounting 83% of used cars to the customer. So we put in AI generated alerts. So if a car has a discount in excess of 500 quid, it goes to the operations director. Immediately the deal is concluded with details of the deal. And if the discount is above £1,000, it actually comes to me.
Yeah.
And then we have an inquest. And we've reduced the discounting from 83% to 50%, which is quite, in the number of used cars we do, is quite a material impact, actually, in terms of margin. And we also discovered with these alerts quite quickly that we had the most generous colleague purchase scheme on the planet. some of our more intelligent members of the community were going and working out what the policy was, working out
how many cars can they buy per year through the.
We were giving discounts of £4,500 on some cars, which is good money if you can make it, isn't it? So we clamped down on that and put a limit of 2,000 in. So we've done a lot of work, and I think that's a very good example of where AI can actually generate value.
Yes.
In terms of providing better information.
Maybe Curtis, Robert's the one to ask about your experience of QR code to get a price on a used car.
It's a bit of a diversion, this, but a week or so ago, I took my car in to get it serviced, and I always wander around the dealership, look at the forecourt. It's not one of yours.
He's one of them tie kickers, Robert, by the way. Just,
An absolute time waster. Always look at the used car forecourt. And this particular used car forecourt, so it was a franchise dealer. It didn't have any prices on its used cars. It just had QR codes. So every car you went up to, you had to scan it to get the information on the car, engine size or whatever, and also price. Is that something that's happening now?
Oh, we implemented that 2 years ago.
Really?
So the QR code takes you directly to the vehicle display page on the internet for that particular car with the price. And the answer, the reason why we have to do that is, can you imagine the chaos if we had an algorithm repricing 70 to 75% of our used cars every day? Yeah. I mean, I'd have an army of people changing price boards. And let's be brutally honest, 50% of the prices on the forecourt wouldn't equate to what it was on the web.
Been there, done it.
I mean, we all know. So that is why QR codes are absolutely required. Now, in fairness, and this is a trading standards thing, if you actually walk towards the dealership, certainly in our business, you will find a price list in the window of every car, actually. So you don't have to use the QR code if you don't want to.
Well, Philip and I had this debate on the podcast about it, and it was sort of concluded that it's great for retailers because you've got that flexibility, as you say, with price changes, but not a great experience for the retailer. For the customer who's wandering around and just trying to benchmark cars because they've got to scan every single barcode.
Yeah, I don't actually think they do that anymore.
No,
really. I think most people do a lot of their research on the internet.
Yeah.
Oh,
they
right.
come in, they know broadly what's what. They've probably got a target car in mind. And then once they engage with the sales executive, we can then sort of introduce concept of other price cars. I understand your point, and it's just not practical.
It's probably a minority
changing 75%. Yeah. I mean, let's be honest. We have price boards when we used to change the car prices once a month.
Yes. Well, as a tire kicking experience, it wasn't great, but I can see that it does work.
Yeah, but to be honest with you, you'd just be wasting everybody's time, Curtis.
Yeah, exactly. Now, Robert, we couldn't have you on without asking you about the introduction of the £40,000 expensive car supplement, which was introduced on EVs in April. Now, this is clearly something outside of the control of retailers. So how are you mitigating it?
There is nothing we can do to mitigate that. The manufacturers have mitigated it, because I was with one manufacturer yesterday and their entire range is now all priced below 40 grand.
Really?
So I think the manufacturers are doing quite a lot of work to mitigate it. It clearly was an absolute nonsense. I mean, who could have a regime of fining manufacturers if you don't sell electric vehicles and then increasing VED and other charges on sale of electric vehicles? I mean, you've got to be particularly stupid, I think, to come up with such a thing. And even the government seem to have a bit of a realization of this, because there is now a review going on of lifting the limit or getting rid of it altogether, and that's much to be welcomed. But the biggest impediment to economic growth and entrepreneurship and running a business is not the market, it is not Arnold Clark, it is the government. They are the biggest block to progress, and it's getting progressively worse. And this is a classic example. I mean, we had a letter I asked all my general managers to write a letter to their local MP about a month ago, outlining the problems with the ZEV mandate. And actually, I think 90% of them did write the letter, and I've got lots and lots of replies. And we had a reply from the brilliantly named Minister for the Future of Roads, which is, I mean, I don't know why they're going to need roads if they keep with their anti-motorist policies, to be honest. It's an interesting concept. But she wrote a letter, and I did confirm actually in this letter that the electric vehicle expensive car regime was definitively up for review, which is to be welcome. But I'm fed up of welcoming, backtracks from complete idiocy. These things shouldn't have been in place in the first place.
So she did confirm it's being reviewed. So at some stage we will see that 40,000 raised, presumably.
We will. And I think what the industry is actually asking for now is just a more wider wholesale review of the entire electric vehicle strategy, encompassing incentives, infrastructure, taxation, because it is a big mess, isn't it? Let's be honest.
You do feel like they need to just get a clean slate, don't you, and review it all, because, the flip-flopping U-turns, the changes, it makes investment and strategy planning very difficult, but two, it's just hitting financials continuously. It does feel that, the ZEV mandate, the tweaks to it, welcomed, but let's be honest, not changing, are they?
The government's running out of money at a rapid pace of knots, and Vertu Motors PLC, because of the ZEV mandate, will be paying less corporation tax.
It's counterintuitive of what they are trying to achieve. But we won't get your view on the long-term stability of the UK government and where they'll could end up. But I mean, finally, Robert, I mean, we're just now about to enter June. Your financials up until the end of February. What's your gut feeling of how this year is going to pan out? I mean, there's a lot that is going on in the global market, about politics and the economy, etc. But fundamentally, we always come back to the control the controllables, stick to the basics. There's certain things you can control and certain things that you can't. What's your view on how the year is going so far, your gut feeling, and how you think the year will?
Well, I think Q1 was good because March was excellent. Market was up 14% in new retail. There is a little bit more life in new retail compared to last year, and let's hope that continues. Used car values are solid, so that's helpful. I think there's quite a lot of unknowns for the next 9 months. The first is the impact of Trump tariffs and whether we get more new car volume being pumped into the UK as they divert supply, which would be quite damaging to margins. Second is an unknown about what the changes to the ZEV mandate will mean. Will we get into the same rationing and discounting and a very low new car market, particularly in the second half? And I don't honestly know the answer to that question. But I think the ZEV mandate remains a pretty big problem. And then the third is, where is the UK consumer?
Yeah.
And I don't think they're in that robust health, actually. And I think they could be quite volatile. We've got a lot of political changes. We've got real pressure on the Chancellor. We're going to see very negative headlines about the UK's ability to raise debt, about the squeeze on growth, about the whole economic situation, and that could have quite a negative impact. So I think there are some positives in the sector. Hopefully the Finance Commission issues will get resolved within the next 6 months. We've got residual values fairly good, I think, in used cars, but there's quite a lot of uncertainty. So I think we're being quite cautious, actually, in terms of our outlook.
Yeah, it feels that it's kind of more of the same, isn't it? You need some clarities in a few areas, the Z mandate and what the OEMs will do, particularly in the second half of the year, as you alluded to, that's where the real pressure comes as they sort of start to realise their position in Q3, Q4, which is when the pressure kind of comes on. Yes. And as you say, the discretionary commission is still lingering on in the background with no real clarity of what the outcome will be. And they've got the High Court, but actually it's the DCA that will be the fundamental shift that could impact the sector.
Yeah, and I mean, let's be honest, I think within 6 months that'll all be sorted out.
Yeah. I mean, again, Robert, we could sit and chat for hours on these kind of things. There's so much going on, but it's great, as always, to have you on the podcast just to give a little bit of sort of context to the financials and get your view on the market, which is always welcomed and respected. So thanks for taking the time today. It's appreciated, and I hope the weather clears up a little bit for the weekend, but appreciate.
We don't want it to clear up too much.
No, you don't want it too nice. You want
the like this drizzle.
You want the customers in. You want the customers sat indoors looking at cars on your website, don't you? That's what you want. Yeah. But no, appreciate that. Appreciate your time, and have a fantastic weekend, Robert, as always.
Thank you.
Thanks for coming on, Robert.
Thank you for listening to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising. Philip and Curtis will be back with the week's big motor retailing headlines on Saturday. Live, on demand, wherever you are, on your podcast feed.